Okay, let's get started. Good day to everyone. My name is Marie Muldowney, and I'm the Managing Director at CSI, a part of Moody's Analytics. I'm pleased to welcome you to this webinar on post-pandemic economy, to be presented by Mark Zandi. Many of the participants in this session are advisors who hold a CSI designation. We would also like to welcome attendees who are part of the Global Bank Education Training Standards Board. Today's webinar is being recorded. The ratings, financial reporting analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has the permission to quote any of the comments made or questions asked by the webinar audience. Please note that the following presentation is being offered by Moody's Analytics, which operates independently of Moody's Investor Service, the credit rating agency. For optimal listening, all attendees are currently muted. If you would like to ask a question, please enter it in the Q&A box on the lower right-hand corner of the webinar presentation screen. Note also that we are offering no continuing education credits for this particular webinar. Marshall Bayer will be managing the question and answer session. Marshall is a Senior Director, Credit Credentials and Licensing Strategy with Moody's Analytics and CSI. He's responsible for our learning and credential strategy for the securities area. Our guest speaker is Mark Zandi. Mark is Chief Economist of Moody's Analytics, where he directs economic research. Moody's Analytics, a subsidiary of Moody's Corp, is a leading provider of economic research, data, and analytical tools. Dr. Zandi is co-founder of the company economy.com that Moody's purchased in 2005. Dr. Zandi's broad research interests encompass macroeconomics, financial markets, and public policy. His recent research has focused on mortgage finance reform and the determinants of mortgage foreclosure and personal bankruptcy. He's analyzed the economic impact of various tax and government spending policies and assessed the appropriate monetary policy response to bubbles in the asset markets. Dr. Zandi earned his Bachelor of Science from the Wharton School at the University of Pennsylvania and his PhD at the University of Pennsylvania. As stated, there will be time for questions at the end of the presentation. I would now like to turn over the webinar to Mark Zandi. Please go ahead, Mark.
Thank you, Marie. Good afternoon, everyone. It's good to be with you. Thanks for the 3 hours, Marie. Very kind of you. No, only kidding. Only kidding. Nothing worse than an economist for. I'll prattle on for about 40 minutes and then turn it back to the group and see where you want to take the conversation. So please fire away if you have questions. I'd love to hear them, and we'll get to them later in the talk. I think I should just say, just for sake of disclosure, I don't think Marie mentioned, I'm on the board of directors of a large mortgage insurer, publicly traded mortgage insurer here in the United States, MGIC, going to my interest in mortgage finance. And I'm also the lead director of a large CDFI, Community Development Financial Institution. CDFIs are nonprofit financial institutions that use subsidy to provide capital investments to underserved communities in the U.S. So do that as well. Well, my task is to give you a sense of the outlook of post-pandemic. I know this sounds a bit optimistic, and I am optimistic. I'm going to give a very upbeat talk, and part one will just be an assessment of current conditions. Part two will be the basis for my optimism, and I'll kind of lay that out for you. And I should say I'm really focusing this conversation around the outlook for the Canadian economy, so it's more tailored, specific to Canada. But we'll talk more broadly as well, given how open the Canadian economy is to the U.S. and other economies around the world. And then finally, I will spend a few minutes on the risks, because clearly there are many threats to my optimism. So that's where we're headed. And again, any questions, please feel free, fire away. You can move forward to the first slide, and the first slide gives you, I think, a pretty clear, quick sense of where things stand right now. And it feels like the global economy is just starting to restart after the pandemic recession that hit a little over a year ago now in much of the world. And at this point, the recovery is very uneven. China, a couple of other countries in Asia and the U.S. are leading the way. You can see this is based on assessments done by our economists. We have a little over 100 economists across the globe, each follow a country or analyst for a country, and they make assessments of where the country is in their business cycle based on data and also their subjective assessment of conditions. And I was on a call with the international economists this morning, and we made a couple of changes, which I'll point out in just a second. But the first thing you'll note is that China, a couple of countries tied into the global supply chain in Asia, and the U.S. are leading the way. China is already in the expansion part of the business cycle. That means the economy is growing, and the level of activity, economic activity, GDP, jobs, industrial production, are already back above their pre-recession levels, so in expansion mode. The U.S. is growing, now growing very strongly. I'd say it's even boom-like in the United States here in the last month or two. It's still only in so-called the recovery part of the business cycle, because while it's growing, the level of activity has not yet risen above its pre-pandemic peaks. Although that's going to happen here in short order, at least in terms of GDP growth. Just for context, the US and China together on a market value basis account for not quite half of global GDP. So the fact that these two economies are doing very well and experiencing very strong boom-like conditions means that almost regardless of what's happening in the rest of the world, the global economy is now growing, it's now expanding. These two economies are driving a lot of economic activity. And you can see that in much of the rest of the world, conditions are, quite not there yet. A lot depends on the state of the pandemic, where these economies are. I mean, you can see, for example, I have Canada as an at-risk economy. So the economy is growing. It's certainly not back to pre-pandemic levels, but it's a fragile kind of growth, and there's a lot of risk. And that's more the case in Canada than the United States, because of just the vaccination process is going a lot more slowly in Canada. The pandemic is still creating lockdowns, shutdowns, sheltering in place, much more so than in the US. So in that kind of environment, I consider that economy to still be at risk of kind of falling back into a recession. I don't think it will, and you'll see in a minute. I think growth prospects here are very good in the immediate future. But at this point in time, as of April 2021, it's still an at-risk economy. You can see Europe also at risk. A couple of countries, Italy, Greece, are in recession. And I mentioned the conversation I had with our analysts this morning. There's a lot of debate as to whether Europe is actually in recession. The Eurozone contracted in the fourth quarter of last year because of the reintensification of the pandemic and the shutdowns and lockdowns. And it looks like it's going to contract again in the first quarter when we get that data. So that's 2 quarters of negative growth. So, potentially it's still in recession. The Europeans are a little cautious about arguing these economies are in recession, but that's a reasonable debate. And again, I feel pretty good about Europe's prospects later in the year as vaccinations roll out. But at this point in time, still a very at-risk economy. I will say, just to put a pin in it, I'm a bit nervous about what's going on in the emerging world, and things have kind of gone sideways here pretty quickly, which kind of highlights the risk of this pandemic. It has re-intensified in a very ugly way in a number of emerging economies. Brazil and India stand out. You can see it here. I have them in recovery mode, but our analysts decided this morning to downgrade them. They are now at risk. These economies are really struggling with the pandemic, and no prospect for getting it under control. Quickly. Vaccinations are going to be slow to roll out, and it's going to be pretty tough to get this genie back in the bottle. And we've got a lot of mutations and variants on the virus that are creating all kinds of havoc. So something to watch. It's also becoming more of an issue in some of other EM economies, particularly Southeast Asia, Thailand. Struggling, Myanmar, that's obviously struggling with all the unrest there, the political unrest. Indonesia, you can see Philippines, even Japan is now struggling again with this pandemic. So this is, not going away easily. Still really very much a problem and very much a threat to the emerging economies. And just to highlight that risk going forward, if the U.S. economy and European and Canadian economies really kick into gear as I anticipate, and the EM lags, that will put downward pressure on the currencies of those EM economies, put upward pressure on inflation and interest rates, and that's a pretty noxious mix. So I do worry about the EM here over the next 6, 12, 18 months. But that's really the soft part of the global economy, at least at this point. But this is where we stand. Certainly, still not quite the picture we want to see, but I'll have to tell you, if you go back a year ago when I was showing this chart, it was all in red. There was every single economy on the planet was in recession back March, April, May last year, and so we're making progress, but still a long way to go before I think we all feel comfortable about things. But I do think prospects are good, and that relies on a number of factors. And I'm going to go through a handful of reasons for some optimism here about the outlook. As we make our way to mid-year, certainly the second half of this year, and in the first half of, at least through the first half of 2022. So over the next 12, 18 months, maybe even the next 24 months, I think we're going to see a lot of growth. And just to put a number on the table so you have this in your mind, for Canada, real GDP, I expect growth to be around 6% this year, all in. It's getting off to a very slow start, bad start, but I think we'll be in full swing by the second half of the year, particularly towards the end of the year. And then next year in 2022, I expect growth to be somewhere 4.5%, 5%-ish. And if everything kind of sticks to script, I think the Canadian unemployment rate will be somewhere 6.5%-ish. I know, it's fallen recently, but 6.5%-ish on a consistent fundamental basis by the end of 2022 going into 23. And I say 6.5 because that's a good kind of rule of thumb for full employment in Canada. So we'll be back to full employment if everything hangs together as I expect by the end of 22, or certainly by this time in early 23, 2 years from now. So let's go through the reasoning, the logic behind that. And you can move to the next slide. Reason number one is the pandemic. I do expect a progress, and this gives you a sense of it. This shows when I think different economies, including Canada, which is the orange dotted line, achieve something akin to herd immunity. Herd immunity would result from a combination of vaccination and immunity created by previous infection. And based on what we're seeing in other countries, particularly countries like Israel, which was first out of the gates in terms of the vaccinations, feels like when an economy gets about 60% of its population vaccinated or previously was sick, that's pretty close to herd immunity. You can see big declines in COVID cases. You can see, I expect the U.S. is getting there pretty fast. The vaccinations here in the U.S. are happening very rapidly. We have 50% of the adult population now with at least one vaccine, about a quarter with two vaccines. So we're vaccinating 3-4 million people a day. So that feels like it's going pretty well. Might hit a road bump here pretty soon because there are a lot of anti-vaxxers and people who just aren't going to take this thing. So that might become an issue pretty soon. But I think everything will kind of work out that we'll be at herd immunity here in the US by August, maybe if we're lucky, July, but certainly by August. That's what's shown in the chart. The UK will get there about a month later, September-ish, maybe October at the latest. You can see Canada, I expect Canada to get there. Now things seem to be improving, ramping up by the end of this year, November, December. And then just for context, I put in Mexico and the rest of the world, given what I just said about the emerging economies, vaccinations are going to go pretty slowly. That's going to take a while. So the world does not achieve herd immunity in our forecast, our baseline outlook, until sometime late 2022, maybe even as late as early 23. And I should say, this is our baseline view. So this is the most likely outlook. This is in the middle of the distribution of possible outcomes. And obviously there's a lot of potential outcomes here. So there's lots of different scenarios around this, and not hard to construct it's a lot easier to construct darker scenarios than more optimistic ones. But nonetheless, there's a lot revolves around these assumptions. And getting back to herd immunity is a big deal. That allows economies to reopen. People get back to work in the restaurant industry, hotels, accommodation, recreational activities, airlines, personal services, all the industries that got crushed during the pandemic, they can come back to life. And that's what's happening here in the United States now as we get closer to herd immunity. And some states in the country are acting like we're already there, and so we're off and running. Like I'm speaking to you from my home in Florida. The Florida economy is wide open. If I go out, I'm invariably the only guy wearing a mask in the local convenience store. And Florida is back almost to where it was pre-pandemic. So Florida is kind of leading the way. New York would be the counter to that. New York is still kind of shut down. Offices have my Moody's office in Wall Street down in New York, downtown New York City has not reopened yet, and probably won't until the other side of Labor Day, which is in early September. So New York is lagging, but reopening is a big deal. Very critical, necessary condition for an economy to kick into a gear on a sustained basis. But reason number one for some optimism here is things are, particularly in Canada, things are going in the right direction, and I think by the end of the year, Canada will be beyond herd immunity. Reason number two, and you can move to the next slide for optimism. There's a lot of pent-up demand out there and a lot of cash around the globe. Everyone's been sheltering in place. I've been sitting. I have a home in Philly. That's where I grew up. That's where I spend most of my time. I was on my back deck for 8-9 months. I've been down here in Florida for 4 months. So I've been sheltering in place. I haven't been doing, certainly haven't been traveling very much. I haven't been going to restaurants. I haven't been going to ball games. I haven't been I did get my hair cut. You will notice. In fact, I had someone come here. People are adapting, and they came into my back area here and gave me a haircut. Very happy about that. But I've only had a couple of them over the past year. And because I've been sheltering in place, I've been saving. And so everyone high income, high net worth households, high middle income households around the world have been doing roughly the same thing. And a lot of cash is building up in people's checking accounts. And you can get the sense of the magnitude here. These are my estimates. You can see for the world, excess household saving, that's the amount of saving above which households have done relative to what would have happened if there had been no pandemic, if their saving behavior during the pandemic was similar to what it was back in 2019 pre-pandemic. You can see the third column, $5.4 trillion in excess saving out there. That's cash, largely cash. 6.5% of global GDP. That's a lot of juice that could get unleashed, as economies hit that herd immunity and get out there and start doing things. The U.S. is leading the way. About half the excess cash is in the United States, 2.6 trillion, 12% of GDP. That is a lot of firepower, financial firepower. And not all of that certainly is going to be spent quickly. A lot depends on human behavior. And for high income, high net worth households, they may treat that excess saving as wealth, more like a stock or a bond or real estate, and don't view it as a liquid asset and don't spend it. So I don't think it's all going to end up in spending, but some of it will, and that's a lot of support. You can see the UK not too far behind, about 10.4% of GDP, and then you can see Canada up there in my list. It's the fourth highest in terms of percent of GDP, almost 10% of GDP. So that's a lot of again, financial firepower. Certainly not low income, low middle income households who got rocked by the pandemic. This clearly goes to that K-shaped economy where you get very wide dispersion of impacts on the population. Lesser skilled, lower educated, lower income households got completely hammered by all this. While high income households who could work from home, have good health care, could shelter in place, they're fine. They've enjoyed the run up in stock prices and housing values, no problem. They've got all the cash. By the way, just as a sidebar, all that cash, some of it is ending up in asset markets. So it's one reason why stock prices have gone skyward, why we're seeing real estate values, particularly housing values, go skyward in Canada and the US and other parts of the world. Crypto prices, Ethereum, Bitcoin have gone skyward. A lot of it's being driven by all this cash sitting in people's checking account. But this is another very significant reason for optimism about the economy going forward in Canada and more broadly. Reason number 3, I think I said I was going to give you 5 reasons for optimism, and you should soak this in because I am going to talk about the risks to this optimism after I'm done. So reason number 3, and you can move to the next slide, is fiscal policy. Well, I should say policy in general, monetary policy, fiscal policy. The Bank of Canada has had its foot flat on the accelerator. The Federal Reserve here in the US, flat on the accelerator. Lots of bond buying, quantitative easing to keep long-term rates down, and of course, pegging short-term rates at the zero lower bound very soon after the pandemic hit a year ago. And that remains in place, and central banks are signaling, including the Fed and the BOC, that they're going to continue to provide support until it's very clear that their economies are back to full employment and inflation is back at or above target, especially here in the US. That's the Fed's made that very clear. So the Federal Reserve and monetary policy very supportive to economic growth this year and going into next. And also fiscal policy, and that's what I'm showing you here. This shows all of the fiscal support that different economies are providing since the pandemic hit as a percent of pre-pandemic 2019 GDP. Take a look at the United States. This is, it's massive. So you add up all of the fiscal support provided going back to the so-called CARES Act back in March of 2020, all the way through Biden's American Rescue Plan, which was the $1.9 trillion rescue package that was passed a few weeks ago in March, comes to about 25% of US GDP. That is just a massive amount of fiscal support. Of course, it has a downside in deficits and debt, and I'll come back to that in the risks. But while it's being provided, all that government spending, some tax cuts, that's really juicing things up. And right now, a lot of the money one of the reasons why the U.S. economy is booming, in addition to achieving or reaching, coming closer to herd immunity and all that pent-up cash, is a lot of that fiscal support is now flowing into the economy through checks being delivered to most American households, more unemployment insurance, all kinds of assistance, rental assistance, and food assistance, and money for small businesses and for airlines, and a long list of things. In every country on the planet doing roughly the same thing, although not nearly to the same degree. You can see Japan, Australia, UK adding a lot. There's Canada. The support there also quite significant. At this point, well over 10% of GDP. And I believe there's another fiscal package coming, another $100 billion Canadian dollar package coming, which I think if you do the arithmetic is another 4 or 5% of GDP. So all in, if that package gets into law, and I think it will, it's going to be about 15% of GDP in fiscal support to the economy. So that's a lot of juice to the economy. As I mentioned, there is a downside in the forms of deficits and debt, and I will get back to that. But the other thing to recognize is that in general, this provides a temporary boost to economic growth. Once the spending is complete or the tax cuts expire, then the economy will come back down to earth, and that will, in most parts of the world, including the US and Canada, be sometime in 2022. So I do expect growth rates to really fall off as we make our way to the summer and certainly the second half of 2022. So, a lot of growth near term, next 12, 18 months, but after that, things will slow down pretty quickly. And, that's by design. That's a feature, not a bug. It's to script because, if everything does stick to script, these economies will be pretty close to full employment, and you want the growth rates to kind of settle back down to the economy's potential rate of growth, on job growth to moderate, and unemployment to kind of settle in, at the full employment, unemployment rate, so you don't get inflationary pressures that are uncomfortably high, which is clearly a risk here given all the support. So reason number 3 for some optimism here is fiscal policy. Reason number 4, and you can move to the next slide, is, and this is particularly important for the Canadian economy, commodity and industrial prices have really rocketed higher. And I could have picked a lot of different things to show, but I decided to illustrate the point. What I decided to do was show you our index of a compilation of 15 different commodity prices, everything from metals prices to agricultural prices, to 8 different industrial prices. The thing that matters most, I think, from the prism of Canada is lumber prices, which have doubled over the past year, given the strong increase in housing construction and other factors, which I'll come back to in a few minutes. But you can see commodity prices have gone parabolic here. I do want to point out, I do want to call out one commodity for special mention, because it tends to be a very good indicator of global economic conditions, both in terms of growth and in terms of inflationary pressures, and that's copper prices. In fact, economists call copper Dr. Copper because it has a PhD in terms of predicting how the global economy is going to do in the near term. And copper prices are going skyward. I mean, just to give you some context, in a kind of a typical economy that's performing well, but not too well, kind of just right, everything's, kind of on average, the copper prices should be somewhere around $3 per pound. If the economy is really struggling in recession, like it was a year ago in the teeth of the pandemic, copper prices are $2 a pound or south of that, so less than $2. If it's above $4 a pound, and by the way, yesterday, I didn't look today, but yesterday I looked, it was $4.30 a pound. Anything over $4, that is a scorchingly hot economy. Lots of activity, lots of industrial activity, lots of trade. In fact, industrial production has picked up across the globe, but trade flows, despite global supply chain disruptions, have picked up to a significant degree. And that's a good sign that things are really gaining traction here. Now, of course, this does highlight the increase in prices. Does it highlight the pickup in demand? Global demand also reflects the rationalization of the supply side of many of these markets during the pandemic. It represents or reflects the supply chain disruptions I mentioned. Lumber would be a good case in point for that. Chips, another good example, the chip shortage that we're experiencing is causing some real agita in the vehicle industry because the vehicles can't get produced if they don't have the right kind of chips. Also, the appliance industry is being affected by that. That supply disruptions are affecting prices. And of course, the Trump trade wars, which I know Canada got wrapped up in around particularly softwood lumber, but now particularly between China and the U.S. is scrambling a lot of global activity and leading to higher prices. So, if history is any guide, we should see these prices kind of peak and come down pretty quickly as the supply side of these markets kind of respond. And I would expect that. I expect activity to pick up and production to pick up. And that's one reason why I'm more optimistic about economic growth, particularly in places like Canada, where you have a lot of commodity production. But these price increases may be more persistent because of the supply chain disruptions are longer lasting, and because the pandemic is not over in many parts of the world. I mean, the emerging world, which is key to the global supply chain, is being significantly hampered by the pandemic and the fallout from the pandemic. So we may see even higher prices for longer, and that could lead to greater and broader inflationary pressures down the road here, and something we need to watch. So definitely a risk. But for the time being, something to be optimistic about and savor, particularly if you're a commodity producing country that relies on production. And that certainly is the case, less so than in the past, but certainly still the case for Canada. Finally, let me give you one more reason for optimism, and you can move forward. And I've kind of made the case already, and that's the U.S. economy. That is obviously key to driving global growth, as I mentioned earlier, but obviously, as you know better than anybody, very important to the Canadian economy and Canadian economic growth. I mean, it's hard to see the Canadian economy going off the rails if the U.S. economy is going down the tracks, very quickly. And it is. And this chart gives you a sense of, where we are and where we're headed with regard to what I consider to be the best measure of full employment in the U.S. I mean, you can look at, and policymakers like the Fed look at lots of different things, the most obvious being the unemployment rate, or maybe labor force participation, because we've had a lot of people step out of the workforce during the pandemic to take care of kids who were learning online, or sick family members, that someone had to stay home. But I look at the so-called employment to population ratio for prime age workers, prime age being people that are between the ages of 25 and 54. And you can see, I'm showing you data back to 1985, and you can see it's very kind of stable, and there's a certain regularity through the business cycle. And I'm kind of putting a pin in 80%. So if the prime age full employment employment to population ratio in the U.S. rises above 80%, and that's a combination of more jobs, lower unemployment, more people coming into the workforce, fewer people out of the workforce. If you're above 80%, that's consistent with full employment. That's consistent with strong wage growth, accelerating wage growth, and ultimately, if persistent enough, accelerating inflation. And you can see we just barely got to full employment at the end of the last business cycle in 2019. That kind of got derailed before the pandemic by the trade wars. That kind of sucked the energy out of the U.S. economy coming into the pandemic, and we were already starting to weaken. And then, of course, the pandemic did us in like everyone else. You can see how severe the pandemic recession was in terms of the employment to population ratio. But you can also see how quickly I expect things to come back, and I do expect us to return to that 80% employment to prime age employment to population ratio threshold by the end of 22 going into 23. And you can see how some of the key assumptions that are behind that expectation. This is the baseline view for the most likely outlook for the U.S. economy. In addition to all the fiscal support we've already gotten, I expect another $3 trillion in fiscal support to the economy through President Biden's so-called Build Back Better agenda. That he's already unveiled part of that, the infrastructure plan, which is about 2.6 trillion. That's his proposal. I don't think he's going to get all of that through law and through Congress, but he proposed 2.6 trillion. And I think tomorrow, before his State of the Union address, he's going to Congress and unveil the second part of that plan, which is around social programs, education, childcare, healthcare, family leave, that kind of thing. The family plan, that's going to be another 1.8 trillion. But in total, I do expect that to get through Congress, the Democratic Congress, under reconciliation, and I won't go into that unless you ask questions, and provide about $3 trillion worth of support over a 10-year period. Big chunk of that will ultimately be paid for with higher taxes on corporations. The marginal rate here in the U.S. is going to go up. It's now at 21% for corporations, probably go to 25. We'll see higher taxes on high income, high net worth households. The capital gains tax rate for people who make over $1 million is going up. So we'll see some of it paid for, but some of it will also go to adding to the budget deficit, certainly over the next 10 years, maybe not longer run, but over the next 10 years. You can see I expect the Fed to kind of start normalizing short-term interest rates beginning in early 23 once the economy is clearly at full employment. By the way, that's about the time I expect the BOC, the Bank of Canada, to start raising interest rates. So they're pretty closely in lockstep as they move forward, as you can imagine, understandably so. But that's another 2 years of zero short-term interest rates. And as I mentioned, QE is not going to end for a while here either, probably not until early 2022. And the final thing I just want to call out, there's lots of assumptions, obviously, but the other key assumption that I'm making here is that U.S. foreign immigration normalizes. President Trump really pulled back on immigration. By our count, only 250,000 immigrants got into the U.S. last year, typically about 1 million do in normal times. And I expect Biden to normalize policy and we'll get about 1 million. That is important for growth, both in terms of growth in the labor force, expanding employment, and also in terms of productivity gains. So you can see it's a very kind of sanguine, that looks like a V to me, right? This is a so-called V-shaped recovery, which I didn't expect to get until Biden was elected and we got all that fiscal support, until the Georgia Senate races turned the Senate Democratic and we got all this fiscal support. I didn't expect we're going to get this kind of recovery. But at this point, with all the fiscal juice coming that's been provided and is coming, I think we can be pretty optimistic about the U.S. economy and by extension, the Canadian economy. So you should be feeling pretty good by now. I gave you 5 pretty solid reasons for very strong growth here for the economy, at least through the remainder of this year and through much of 2022. And I think we will be back to full employment in Canada, in the U.S. by the end of 22 or early 2023. So I view that as a very good, upbeat, optimistic outlook, particularly obviously given where we've been over the past year. So let me talk about a few of the risks, and then I'll call it a day and turn it back to you and see if you have any questions. You can move to the next slide. Risk number one. I should say I missed this. This just kind of encapsulates, how quickly different economies around the world are going to get back to their pre-pandemic peak. So this shows the quarter in which real GDP increases above that pandemic peak. As I mentioned earlier, China is already there. It got there in the second quarter of 2020. You can see, I think the U.S. is just about there. It could be in the current quarter. If not in the current quarter, certainly in the second quarter of 2021. And then Canada not too far after in the third quarter of 2021. So we're getting there pretty quickly. You can see the UK and Japan, European Union follow behind more slowly, just given the pandemic and other factors. But this kind of gives you a timeline to returning to full employment, to pre-pandemic levels. Okay, let's turn to the risks, and mostly kind of focus on the downside here. You can turn to the next slide. And the risk number one is interest rates. They're going up. Long-term interest rates are going up. Obviously, short rates are controlled by the central banks, and it's going to take them a little bit of time before they start raising rates. But long rates will, and have already started to move up. And in the U.S., 10-year Treasury yields have moved up about 100 basis points, about a little over 100 basis points, 110 basis points, 1.1 percentage points since the pandemic low back last August. And I'm showing you a decomposition of that here. The blue line is inflation expectations. That's what investors think inflation is going to be. CPI, consumer price inflation, is going to be down the road. And the red line is real rates. So that's the difference between 10-year nominal yields and the inflation rate. And you can see, so I'm just decomposing, cutting in two parts, the 10-year yield, the nominal 10-year yield, into inflation expectations and real yields. And you can see both have increased over the past, since they hit bottom back in August. Most of the increase, though, has been due to a normalization of inflation expectations. They're back somewhere 2.25% to 2.5%. This is consumer price inflation, CPI inflation. So that's pretty much where you'd expect them to be. They've normalized. Real yields have improved a little bit. They've come off bottom. They're not quite as negative as they were back last August at the low, but they are still very, very negative. In fact, negative 75 basis points, negative 0.75 percentage points at the last data point here. And to me, this is, quite strong, makes us quite strong a case for why long-term interest rates are going to rise, because given the outlook I just gave you on economic growth, which real yields are ultimately tied to real economic growth, given the kind of strength I expect in the economy, all the GDP, all the jobs, all the decline in unemployment over the next 12, 18, 24 months, it makes, in my mind, hard to argue for negative real yields. So I expect them to rise and to normalize going forward here. So I would expect, take the 10-year yield, Treasury yield as your benchmark, and the baseline outlook, where say 1.5% today, I expect 2% by the end of the year, 2.5% by the end of 2022, 3% by the end of 23. In the long run, I expect them to be somewhere around 3.5% to 4%, but I don't expect we'll get there for another 4 or 5 years for lots of different reasons, which we can talk about. But that's the baseline. The risk here is that the economy is so strong, inflationary pressures develop to such a degree, inflation expectations rise, real yields rise, and partly because central banks are being so cautious about normalizing short-term interest rates, the economy could really take off here, and that strong real growth and stronger rates of inflation could mean much higher long-term rates than anticipated a lot sooner. Kind of sort of like what happened back after the financial crisis. You may remember back in 2013, then Fed Chair Ben Bernanke started talking about ending quantitative easing, kind of surprised markets, and you saw this big jump, 100 basis point, 1 percentage point jump in long-term rates in a very short period of time. And it did a lot of damage to interest rate sensitive sectors of the economy like housing and the broader economy. And of course, the Fed wants to avoid that. And that's not in my baseline outlook, but I view that as a very significant risk here, near-term risk, because the Fed's going to have to start talking about, just like the Bank of Canada, it's going to have to start talking about tapering QE, and it's going to be difficult to articulate that without upsetting investors and causing rates to spike and doing damage to the economy. So that's risk number one. Risk number two, and you go to the next slide, is asset markets are overvalued and, arguably very overvalued. And in some cases, arguably, there's some bubble-like kind of conditions developing, speculation starting to creep into markets. And you can kind of see that in the US equity market. And this is kind of evident to one degree or another around equity markets all over the developed world, including in Canada. In the US, multiples are very high. And this is my favorite measure of valuation in the equity market. This shows the ratio of the value of all publicly traded stocks as measured by the Wilshire 5000 to all economy-wide corporate earnings. So it's like an economy-wide price earnings multiple, by measure of valuation. You can see by this measure, we're back today where we were in the teeth of the Y2K, late 1999, early 2000 equity bubble. That was a bubble, a lot of speculation, and you can see it collapsed, and it hurt the economy, sent the economy into recession in early 2020, late 2020, early 2021. And there's reasons why valuations should be high. Strong growth prospects, very low interest rates. I mean, if you have a low rate, the discounted value of future earnings is higher, so therefore, you should have high values and high PEs. But even abstracting from all of that, they are very highly, equity prices are very highly valued. And if interest rates rise more than anticipated, I think that valuation will become an issue. We'll see, very significant corrections in equity prices. We'll see corrections anyway, despite, even in my baseline, it's hard to imagine the equity market going straight up here in the next 6, 12, 18 months. But it could go down much more significantly and be down persistently and do more damage to the economy than anticipated. By the way, I just picked the equity market as the poster child, but you can talk about housing markets, single family housing markets. You could talk about commodity markets. You can talk about crypto markets. Talk about speculation. Bitcoin and Ethereum are vehicles for speculation, and they, have gone skyward and, are particularly vulnerable. Not that that's going to do any significant economic damage, because ownership of that is pretty narrow across households. So it's not a threat to the broader economy, but it is symptomatic of, the speculation that's creeping into the markets, and thus the risk here. Risk number 3, and you can go to the next slide, that I alluded to earlier, is we've been borrowing a lot of money. Sovereigns, governments, to help get their economies, allow them to navigate through the pandemic, a lot of deficit finance spending and some tax cuts, and we're running out of so-called fiscal space. Certainly have much less of it than we did, and this is we'll have even less of it a year or two from now. And that's the point of this chart. The x-axis, the horizontal axis, is the debt to GDP ratio for the countries shown. This is sovereign debt to GDP ratio for Treasury debt, so example for the US. The y-axis is fiscal space. That's the difference between the actual debt to GDP ratio and that theoretical debt to GDP ratio that we estimate, above which investors will begin to lose faith that they're going to get paid in a timely way because debt loads are so high. They begin to question the timeliness and whether they're going to get paid. They demand a higher interest rate to get paid, compensated for that risk. That a higher rate gets embedded in interest expense, which gets into deficit and debt, and you get into kind of a self-reinforcing kind of negative cycle. You can see some countries have no space already. They're kind of at the limit, at least theoretically. They're at the zero fiscal space line. I'll mention a few: Russia, Turkey, South Africa, Egypt, Argentina. You can see Spain and France aren't too far away, though. They're pretty close. Italy, Greece, Japan. And you can take a look at US. US is a big blue bubble. The size of the bubbles is the size of the economy. Canada is within the bubble, and both are around 150% of debt to GDP of fiscal space. That may sound like a lot, because debt to GDP in the US now is a little over 100%. But I point out that, the debt to GDP ratios are rising pretty quickly here. And this is theoretical, and a lot of the standard error around these theoretical estimates are very high. So, I do think we should feel uncomfortable with this. And once the economies are back to full employment, and obviously so, it's time for governments and populations to pivot and start addressing their fiscal issues. Because if they don't, I do think at some point investors are going to lose faith, and we're going to have some type of fiscal event, kind of sort of like the European debt crisis after the financial crisis back in 2010, 11, and 12. So I view this as a pretty significant risk, not for this year, not for 2022, but as we make our way in 23 and 24, when we are at full employment, interest rates are rising, and investors are going to be questioning whether they're going to get paid back in a timely way. Finally, and let's go to the last slide, in the last risk, I just want to make it very Canadian centric, and that is, I mentioned this already in the context of interest rates and the equity market. Canada's housing market is red hot, and it has been for quite some time, even well before the U.S. housing market. And the one distinction between the U.S. and Canada's housing market is, at least this go around, is that the U.S. housing market has not been supported by a lot of flipping, speculation, or leverage. And that's less of the case in Canada. And you can see the very strong relationship, inverse relationship between house price growth and interest rates. And I'm measuring that here by the apropos 5-year mortgage rate, which is the blue line. The house price growth is the green line. Take opposite scales just to kind of make it easier for you to see the relationships. You can see where history ends and forecast begins. And you can see I kind of laid the case for rising interest rates. This is my baseline. You can see what happens in the baseline. I do expect house price growth in Canada to cool off nationwide, to kind of go flat by the end of 2021 going into 2022. And that means some markets are actually going to experience some price declines, which raises the prospects for some credit risk if leverage is too high. And this is the baseline. If rates rise more than anticipated under the risk scenario, then obviously, that prevents more issues with regard to house prices and credit risk going forward. So just calling that out, not something you don't know. You know this probably better than I, but I think it would be inappropriate for me not to mention this as a risk. So I covered a boatload of ground there, and I did it in exactly 40 minutes, Marie Marshall. I nailed it, and I'm going to turn it back to you and see where you want to take the conversation.
Okay, that's great. Thank you so much, Mark, for that informative presentation. Lots of questions. Some of them were asked earlier in the presentation, but your presentation then did answer them as we moved along. But there's a few questions around the expansion of the Fed's balance sheet and concerns you might have that the genie will come out of the bottle and will experience the kind of inflation that we saw, I guess, back in the 1970s and early 1980s. So what are your thoughts on that?
On inflation. So, and of course, there's the Fed's aggressive policy response would be one factor leading to worry, concern about inflationary pressures down the road. The other being fiscal policy, the commodity prices. So there's a lot of different kind of dynamics at work, lifting inflation and leading to the concerns that inflation is going to be at some point uncomfortably high down the road here. Let me just articulate the baseline view, again, the middle of the distribution of the most likely scenario. And that is a pretty sanguine one. I expect inflation to pick up. It's been uncomfortably low. And as I think most people know, it's been well below the Fed and other central banks' targets now for almost 20, 25 years, more or less. I mean, in brief shining moments when it rose above that 2% target, but only briefly. So it's been really 20, 25 years of suboptimal inflation. So I do expect that the pandemic and the policy response, both fiscal and monetary, will fundamentally lift inflation above, back to the 2% target, and at least in the case of the United States, above that target for a consistent period, which is by design. That's what the Fed wants. And the Fed changed its monetary policy framework at the end of last year and said, look, if inflation is consistently below my 2% target, then I need inflation above that 2% target on a consistent basis, so that through the business cycle, it all averages out to 2%. And the logic behind that is pretty straightforward, because if you don't do that, then because in a business cycle, you always have recession, and inflation always will be below target in that recession. That means that on average through the business cycle, inflation will be below 2%. Inflation expectations will then be below 2%. And therefore, you'll never get to the 2% target that you had in the first place. So just the mechanics of this means that if you're below inflation on a consistent basis, you need to be above it on a consistent basis so that it all averages out. So the Fed says, I want that, change its framework for doing that. And in my baseline, I expect they'll get what they want, that they'll get accelerating inflation over the next year or two, 2 years, 3 years down the road when the economy is back to full employment. we kind of settle in above that 2% target, and in the very long run, kind of in the second half of the decade, it kind of settles in around the 2% target again. So very sanguine, all feature, no bug. Having said all of that, I say that the risks are skewed to higher rates of inflation that are than are desirable. And I'll give you a couple of reasons for that possibility. One is just these commodity spikes. I mean, economists will tell you and central bankers will tell you, don't worry, this is very common coming out of recessions. Supply sides are impaired in recessions. You see these spikes, and then the spikes elicit an investment response, and the supply side expands and revives, and prices come back in very quickly. In fact, come way in many cases. So it's temporary. It's not going to be around for long enough to really get embedded in wage and price dynamics. Don't worry about it. Well, I worry about it because the pandemic is more idiosyncratic. Supply chain disruption is more serious. The trade war, more of an issue. The pandemic is still raging in different parts of the world where the supply chain runs deep and can be disrupted. We're operating in lots of markets with no inventory that got really drawn down in the recession. So this could be more persistent. And if it's more persistent, then it could get embedded in the kind of the wage price dynamics more broadly. Second reason that inflation might end up being more significant than expected in the baseline. And here I'm speaking with a higher degree of speculation. Of course, all forecasts are some form of speculation, obviously, but sometimes when I speak about the future, I speak with high levels of confidence, sometimes less. And this is a case where I'm speaking with less confidence, just because I haven't done as much work here on my own. But one thing I have observed is the pandemic has caused a concentration of market share in lots of different industries across the economy. Retail is the poster child for that, right? All these mom and pop retailers, small retailers got wiped out in the downturn. Even mid-sized publicly traded retailers, many of them have failed, gone into bankruptcy, been really pared back. And that's all to the benefit of the bigger retailers who are grabbing market share. And I don't need to name names, you know them as well as I do. And I'm now speaking to you as a business person. If you have market power, you tend to use it. You will raise prices more aggressively on a consistent basis. So if the pandemic has in fact resulted in a concentration of market share in different industries, it stands to reason that we're going to have higher rates of underlying inflation going forward. The final thing I'll throw into the mix that has actually been a little bit of a surprise to me is that wage growth has held up much better than I would have thought in industries that weren't directly impacted by the pandemic. So if you were directly affected by the pandemic, accommodation, hotels, recreational activities, leisure hospitality, personal services, airlines, transportation, yeah, you got hit hard, a lot of unemployed, underemployment, wage growth is moderated. But in the rest of the economy, which is the bulk of the economy, pretty much untouched. And labor markets have remained very tight as they were pre-pandemic. Wage growth is held very firm. So if the economy really does rev up here, like I'm anticipating, across the entire, it's not just the industries that are coming back to life and on the side of the pandemic, it is all industries. We could see pretty tight labor markets, much stronger wage growth, and obviously accelerating wage growth from these higher levels that prevailed prior to the pandemic is the fodder for a more fundamental increase, an uncomfortably high increase in underlying inflation. So baseline, it's a pretty sanguine view, but at this point, I think the risks are skewed towards higher rates of inflation than I think we would feel comfortable with. And of course, that would elicit a sooner response by central banks. They'd have to ease up on they'd have to start tapering their quantitative easing and end their quantitative easing more quickly and start raising short-term interest rates more rapidly. It also means long-term rates would rise more quickly, and that's more of a risk scenario. That goes back to my concerns about overvalued markets, particularly in the context of a rising rate environment. So a lot there.
Great, thank you. Any thoughts about the long-term economic impact from permanent changes to the workplace?
Yeah, I think there are going to be many. Let me mention a few. First, and here I'm speaking half with my economist hat on, the other half with my business hat on, my personal hat on. And first is less travel. Now, domestic travel, that'll pick up. That's where a lot of the pent-up demand will get unleashed, I think, 6, 12, 18 months. Global tourism, that'll take longer to pick up, because the pandemic is still raging in many parts of the world and people aren't going to be able to travel. I just saw Europe open up to American travelers for the summer if they got a vaccine. So that's good. So we're making some progress, but it's going to be a slow progress. So I don't think global travel is going to get back to normal for at least 2, 3, 4 years. It's going to take a while. Business travel, that's not coming back in my lifetime. I just don't see it. We're doing this. If we hadn't been doing this, I guess I'd be visiting you in Toronto, speaking to a group of people. But this is very effective, right? And very, I can get my message across very easily. You can do it at your leisure, and the costs are gazillion times lower. So we're not going back, and so that's going to have all kinds of implications for the leisure hospitality industry, entertainment industry, airline industry. On and on and on. Second, work from anywhere. That's real. I don't think that's a temporary fad. That's a fundamental shift. Now there'll be some swinging back, as we reopen and offices reopen, but we're not going back. I'll give you a statistic. This is U.S. Before the pandemic, less than 10% of the U.S. American workforce worked from home on a consistent basis. In the teeth of the pandemic, a year ago, it was 35%. We're now down to 20, 25%. I'd say, when offices reopen later this year, we're back down to somewhere, we'll bottom out somewhere between 15 and 20. And then we're going to start rising again as people and businesses figure this out. There's a lot of niggling HR issues you have to figure out. Like, I'll give you a Moody's issue. Suppose I worked and lived in New York, and now I want to live in Florida because it's cheaper. My housing is much less expensive, no commute, no income tax, and the winters are pretty damn good down here. So summers are a problem, but you can figure that out. But winters are damn good. So, but if I do that, should I get paid New York wages or should I get paid Florida wages? The answer is probably something that certainly Moody's would say Florida wages. They're a lot lower, and I suppose that's the direction we're going to go ahead here. But at the end of the day, that's a process, and so it'll take some time. But it'll happen, and so I think work from anywhere is another fundamental shift in the way we live and work. And then I can go on and on, but I'll stop and I'll take one more question because we're running out of time. Online, obviously, that was happening before the pandemic, but that has been supercharged in the pandemic, and there's no going back on that. And that has a gazillion kinds of implications for the way we live and work.
Okay, thanks, Mark. Here's another question. The Canadian debt to GDP ratio, which you pointed out, is extremely high, and the 5-year CDS keeps rising, but Canada is still rated as a AAA economy. What is your opinion on this?
Well, first of all, you should know, and I'll just say it because everyone knows it, I'm not in the rating agency, so I have nothing to say about the ratings or have an opinion about their ratings. I have no particular insight into how they're thinking about things. I will say that the Canadian economy has been, perhaps with the exception of this vaccine rollout, sorry about that, but exception with that, the best managed economy on the planet, bar none, from a economic, geopolitical perspective. I just think back to the United States, a few months ago. It was complete chaos, politically and economically. So it's a very well managed economy, and I have a lot of confidence that it will be able to manage its fiscal situation and its debt situation. In part because when push comes to shove, it'll take the hard steps necessary to address them. Even that, I mentioned that 100 Canadian dollar fiscal package. I think here I'm getting a little out of my strike zone, but and you can correct me if I'm wrong, but I think most of that has pay-fors, out there. Some of them might be debatable, how much of a pay-for, but I think they are paid for. But I think the other thing I'd say is Canadians tend to show, once they're shown a problem and very clearly, and the dots can be connected between what the politicians are saying and what the reality is saying. Canadians respond and react and have enough political unity to make changes that are necessary. Very different in the United States. We have a lot of resource and we have a lot of market power, and that's why we have AAA, because we are the reserve currency on the planet. We're the biggest planet on the economy. We are a free society. You know, we got a lot going for us, so we're AAA. But the one thing we don't have for us that Canada does have, at least relatively speaking, I'm sure you're hammering about this all the time, but relatively speaking, is your ability to get things done when you need to get them done. So, you know, and going back to my fiscal space graph, you know, the theoretical, to be more precise about it, the theoretical point of no return is that place where Canada or these countries have never been historically. So it's not like things can't be turned around. That's not what that graph on fiscal space is saying. It's just saying that to turn things around, you're going to do something you've never done before. But I'm pretty confident if anyone's going to be able to do that, it would be the 35 million Canadians. I think I got that number right. That you guys can do it. So I have confidence in you.
Okay.
Mark, we're at the top of the hour, and the hour's gone very quickly. Thank you so much for a very comprehensive view of the pandemic and post-pandemic period. It's interesting to see some of your perspectives. Thanks, Marshall, for managing the questions.
Hey, Marie,
yes,
can I say
please,
one last
Mark.
thing? And Marshall, I strive, just so that everybody knows, so we all level set here, I strive to be 51% right. Just saying, 51%. So.
Yeah, we understand.
Got it. Perfect. All right. So this concludes our event. If you have any additional questions, please email designations@csi.ca. A replay of this event will be available in the coming days. So thank you for attending and have a great day. Bye now.
Thank you.
Bye, everyone.
Bye-bye.